On a corporate balance sheet, an asset's carrying amount is a strict mathematical proposition, its historical cost minus accumulated depreciation. This number represents the asset's theoretical book value at any given moment. The inherent risk in relying on this metric is that it assumes a predictable, stable trajectory of utility over the asset's entire lifespan. Economic reality rarely offers that kind of stability. Adverse conditions can arrive without warning. A piece of specialized equipment might become obsolete overnight, or the market price for a specific facility suddenly drops. When that happens, the economic utility of the asset is destroyed, and the carrying amount becomes a fiction. To correct this fiction, accounting rules require a process called impairment. An impairment is a permanent write-down recognized when an asset's carrying amount can no longer be recovered through its future use or sale. The rules to record this write-down are not uniform. They follow a strict decision tree, dictated entirely by the asset's specific lifespan profile. We can map these rules using an impairment protocol decision tree. You'll follow one of three primary pathways: finite-lived assets, indefinite-lived intangibles, or goodwill. Each branch demands different triggering events, testing steps, and measurement metrics to determine the loss. We rely on these rigid lifespan protocols to mathematically enforce the principle of conservatism. They ensure a company never projects a false sense of financial health by overstating the value of the assets it holds. We begin with the finite useful lives branch, covering assets like machinery, equipment, and buildings. You do not test finite assets for impairment automatically. The process requires a specific triggering event or a significant change in circumstances to initiate the review. These triggers include severe adverse changes in the asset's physical condition or a significant decrease in its market price. If a trigger occurs, you enter the core complexity of this branch. The impairment test is a strictly ordered two-step process. This text from example 5-4 demonstrates step 1, the recoverability test. We have a machine at the end of year 2 with a historical cost of $200,000 and accumulated depreciation of $40,000. To test recoverability, we compare the asset's current $160,000 carrying amount against the sum of its undiscounted future cash flows, estimated here at $150,000. Because the $160,000 carrying amount exceeds the $150,000 in expected cash flow, the asset fails the recoverability test. It is deemed not recoverable, which legally mandates step 2. This is a common trap for practitioners. Undiscounted cash flows are used exclusively as a pass-fail threshold to trigger further testing. You never use them to calculate the actual financial loss. Once the recoverability test has failed, we transition to step 2, measurement. The impairment loss formula is strictly defined as the excess of the carrying amount over the asset's fair value. Applying this to our machine, we take the $160,000 carrying amount and subtract its actual fair value of $136,000. This leaves an exact impairment loss of $24,000. This table maps how that $24,000 loss impacts the fundamental accounting equation on the balance sheet. The entry recognizes the impairment loss immediately in income, which decreases stockholders' equity. Simultaneously, accumulated depreciation increases by the same amount, driving down total assets to keep the equation balanced. U.S. GAAP enforces a strict rule on this adjustment. Once recorded, a previously recognized impairment loss must never be reversed. The new lower carrying amount becomes the permanent cost basis. This intentional restriction prevents companies from artificially inflating future earnings if market conditions happen to improve. The rules completely shift when we look at the remaining two branches: indefinite useful lives, like non-amortized intangible assets, and goodwill. These assets do not wait for a catastrophic market event to trigger a review. They mandate impairment testing at least annually. However, both branches offer an optional qualitative assessment step. Management can evaluate economic conditions before committing to the heavy math of a quantitative test. If the qualitative assessment determines it is more likely than not, meaning a greater than 50% probability, that the asset is not impaired, they bypass the formal quantitative test entirely. If they fail that assessment, the quantitative test for indefinite assets is straightforward: a direct one-step comparison of carrying amount to fair value. Undiscounted cash flows play no role here. The goodwill branch requires further isolation due to a unique structural constraint. Goodwill cannot be tested on its own. It must be tested at the reporting unit level. To find the impairment, you compare the fair value of the entire reporting unit against its combined carrying amount, including the allocated goodwill. If the carrying amount exceeds the fair value, a loss is recognized. But note the strict limitation. The loss is permanently capped at the total amount of goodwill already allocated to that specific reporting unit. And exactly like finite assets, goodwill impairment losses hit the income statement immediately and can never be reversed in subsequent periods. Mandating these annual tests ensures that invisible, creeping deterioration in intangible value doesn't secretly inflate a company's equity over time. We can now step past the impairment protocols and examine the final phase of a long-lived assets journey: disposal via sale. Disposal represents the ultimate reconciliation. It is the moment an asset's theoretical book value meets the actual cash proceeds it generates upon exit. Before calculating any disposal metrics, the prerequisite rule is absolute. You must calculate and record depreciation up to the exact date of the sale. Looking at example 5.5, we can observe the mechanics. A company sells a machine with a $100,000 carrying amount for $135,000 in cash. To clear the ledger, we debit the incoming $135,000 in cash and debit the $80,000 in accumulated depreciation. We then credit out the original $180,000 historical cost of the machine. The $35,000 discrepancy between the cash received and the book value acts as a balancing plug. It is credited as a gain on disposal, which directly increases stockholders' equity. The math flips in a loss scenario. If the exact same machine were sold for only $90,000, receiving $90,000 for an asset carrying a $100,000 book value requires a $10,000 debit to loss on disposal to balance the accounting equation, decreasing equity. Both gains and losses on disposal bypass any deferred accounts and are recognized immediately in the income statement. Disposal permanently converts an asset's theoretical utility into a realized economic fact, closing its life cycle on the ledger once and for all. Finite assets waiting for market shocks. Indefinite assets under strict annual scrutiny. The final clearing upon disposal. Each of these distinct pathways is driven by the exact same North Star principle, the strict enforcement of conservatism. By applying these specific protocols, financial professionals ensure the corporate balance sheet remains an accurate map of true economic health.